does a secretive hedge fund wipe out $10 billion and bring down one of the world's oldest banks with it? This is the inside story of how Archegos Capital, a family office no one had ever heard of, exploited the financial system, and how Credit Suisse ignored every warning sign until it was too late. To understand the Archegos collapse, we need to go back. After the 2008 financial crisis, hedge funds came under tighter regulation, but family offices, private investment firms that managed the wealth of every single individual or family, were exempt. Bill Hwang, a former protege of Tiger Management's Gillian Robertson, founded Archegos Capital in 2013. It was technically a family office, but operated like a high-stakes hedge fund. And because it wasn't regulated like one, few people asked questions. Credit Suisse, meanwhile, was a 167-year-old bank desperate to stay competitive with Wall Street's biggest players. But beneath the surface, it was riddled with risks, scandals, and weak internal controls. Archegos made huge bets on tech and media stocks like Viacom, CBS, and Discovery, not by buying shares outright, but using total return swaps. These swaps let Archegos bet billions with just a fraction of the capital, using leverage from multiple banks. Through prime brokerage accounts, Wang borrowed from Credit Suisse, Nomura, Goldman Sachs, and others. But here's the twist. Each bank thought Archegos was a relatively low-risk client. None of them knew the full extent of his leverage. Why? Because swaps don't require public disclosure. It was a legal blind spot and Archegos exploited it. By early 2021, Archegos held exposure worth over $100 billion on only about $10 billion of capital. This wasn't investing. It was a high wire act with the safety net removed. Bill Hwang, a devoted Christian and reclusive billionaire, had already faced insider trading charges in 2012, fined $44 million. But after lying low, he returned with Archegos, and banks lined up to fund his comeback. Credit Suisse risk team flagged Hwang repeatedly, but the bank's top leadership, driven by bonus targets and fee revenue, chose to look the other way. Warnings were ignored, internal audits were delayed. By March 2021, Viacom CBS stock tumbled. Archegos, over-leveraged, couldn't meet margin calls. The house of cards began to collapse. Let's follow the money. When Archegos defaulted, Credit Suisse lost $5.5 billion. It was one of the biggest trading losses in the bank's history. Internal reports revealed that risk managers had raised red flags for months, but executives ignored them in the pursuit of short-term profits. Nomura lost $2.8 billion. Japan's largest investment bank was blindsided. They later admitted they had no idea how concentrated Archegos' positions were or how exposed they truly were until the damage was done. Morgan Stanley and UBS were exposed. Both banks suffered losses, though not as severe. What's alarming is, even with world-class risk departments, they too failed to see the full picture, proof that opacity in the derivative market is still a ticking time bomb. Only Goldman Sachs and JP Morgan escaped with minimum damage because they sold early. They moved fast, dumping billions in Archegos linked shares before the market fully reacted. It was ruthless, but it saved them billions. The difference? They prioritized risk over relationships. So how did a private firm collapse cause a $10 billion firestorm? Because swaps allow Archegos to borrow from multiple banks without any one of them seeing the full risk exposure. Credit Suisse failed to demand more collateral. Its internal systems were fragmented. The money vanished because the oversight never existed. The fallout was immediate. Credit Suisse's CEO resigned. Regulators in the US, UK, and Switzerland launched investigations. Credit Suisse shut down its prime brokerage division. In 2023, Credit Suisse was forced into a shotgun merger with UBS, ending its independence after 167 years. Archegos revealed just how fragile and opaque global finance had become. Billions changed hands without a single regulator noticing until it was too late.
Let's start with the Archegos stuff, because you saw the news today. $10 billion now, the total for, when you add in UBS's latest estimate and Nomura's latest estimate, and you were caught up in that, and that's what we're looking at on the chart right there.
With this Archegos gray swan, effectively, black swan. Really, the way that we look at it is, unfortunately, I got to know a lot more about swaps and some exotic instruments than I ever wanted to know. But that's kind of a lot of noise. We're back at work, and ultimately, the stock is going to be where we deserve it to be, and that's going to be based on us executing.
What can we learn? Regulatory loopholes still exist, especially around derivatives and swaps. Banks prioritize profits over risk until disaster hits, and family offices can behave like hedge funds without any of the scrutiny. This wasn't just a failure of one fund, it was a systematic blind spot that exposed how little we've learned since 2008. If you found this breakdown helpful, hit that like button and subscribe, because we're not done. We're digging into the next collapse, the next shadow player, the next money trail. Drop your thoughts in the comments. Should derivatives like swaps be more tightly regulated? Follow for more deep dives, and remember, when in doubt, follow the money.